Right here in the newsroom with me, keeping me company, Hedgeye Risk Management out with its themes for the third quarter. You're going to want to listen to them. Last quarter, the independent research firm told investors to go long the U.S. dollar, short the euro on spreading sovereign debt issues. So right about that. If you heeded that call, you would have missed more than a 13% drop in the S&P 500. But for more on what Hedgeye is telling investors to do this quarter, we are joined by Hedgeye's CEO, Keith McCullough. He is a former portfolio manager at Carlyle's Blue Wave Hedge Fund, is currently a Bloomberg TV contributing editor. You're giving good advice, Keith. You're getting a lot of things right. So good to talk to you about what you see coming. American austerity is one of the notes that you recently just put out, saying we should be taking a page from the Canadians. I hate to say that, even when Eric's not around, but and even Scottish strategists. So we're going to have to buckle down here.
Yeah, I think yesterday Neil Ferguson actually echoed a lot of what we said on our conference call, and it's called American austerity because we quite simply think that the U.S. is going to go down the exact same path that the Europeans have. It's just a difference in timing, and that difference in timing is basically based on debt maturities. Now, the U.S. debt maturities really start to get nauseatingly high in 2011. As we approach 2011, we want to be in front of that. Short the dollar now instead of short the euro, and it's basically the same short case. It's based on sovereign debts, deficits, and debts as a percentage of GDP.
All right, now one thing that the U.S. economy has been struggling with for at least 2.5 years is housing. What is your call on housing? Where do you see this fitting in with what the average person should be doing with his or her money?
Our second call is called housing headwinds. Now, this is an interesting one for us because we've been bullish on housing for the last year. Now we're making the turn, much like we're making the turn on the dollar here. And I actually think that making a short call on housing here is the easiest call to make relative to any call that
you say it can go further down. No matter what you think, things can get worse.
Oh, definitely. 15 to 20% downside from here in U.S. housing prices, and we're using the Case-Shiller Index as a barometer for that. But really, you look at the supply-demand imbalances currently, and you look at supply and demand as a leading indicator for price. You know, the R-squareds that we're flashing in are about 0.8, which is extremely high as a leading indicator, and we're going to go with the math on this. We're going to be negative on housing for at least the next 3 to 6 months.
And part of that is just, I mean, we haven't even begun to see the glut as far as foreclosed homes go. I'm assuming that's part of your
All of our estimates are actually based on taking out the shadow inventory, taking out all the foreclosures, and just looking at the raw data on pending home sales, new home sales, and MBA mortgage applications. In the last 8 weeks, Deirdre, these MBA mortgage applications have dropped like a rock. On a monthly basis, they're down to the same levels of 1997. So at the same time that Bernanke and the government is daring Americans to basically lever up and get a mortgage, Americans are like, we're not dumb enough to do that yet. So we're seeing demand fall off significantly.
Even with prices so cheap, that's worth noting because you can get a mortgage for a pretty low rate.
Right, and yeah, mortgages are as low as they can ever go. But housing prices, there's a misconception. It's like tulips. After the bubble, it doesn't mean that tulips obviously become a bargain. A bargain that remains a bargain is no bargain. And Marty Whitman said that. I don't have to take credit for it. But we definitely think that people's conceptions of what they hold most dear to themselves are too high, which is the price of their home.
All right, from the Dutch tulip crisis, we'll ignore their World Cup victory for the moment and talk about bear market macro. That's your third big theme for the third quarter. What are you seeing?
Well, bear market macro is as bearish does, which is we're bearish on almost everything from an equity perspective, both locally and globally. We've been bearish on China, but we're more forcefully bearish now on the U.S. We don't think that people are bearish enough yet on U.S. equities. We've been using a downside target of 1018 on the S&P 500. Last night, we changed that to 1001. So we think we're going to make lower lows and a series of lower highs on rallies, much like you saw intraday yesterday. There's a lot of hope that we can go into some GDP growth scenario that is more accommodative than I think. I think GDP growth estimates are too high by a double. If you look at the Bloomberg estimate on 2011, we're at 1.7%, and I think consensus is almost 2 times that.
All right, Keith, and as we mentioned at the beginning of our chat, it pays to listen to you at least in the second quarter. You called for that April flowers, May showers, market tank in May, and you were right. So bear market macro, the third theme there from Hedgeye Risk Management. Keith McCullough, thanks very much.